We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to show two examples, one of a bear trap and one of a bull trap in the current markets. Now here's a good diagram explaining what a bull and bear trap is. Here's a bear trap, price comes down, bounces and continues to go lower, breaks critical support, all the moving averages begin to roll over, the momentum is negative, and all of a sudden there's a demand spurt that pushes it back up. So all the people who loaded up thinking it was going to go down and whatever the fundamentals are thinking of are tricked by the demand that comes in, because the people who are playing this game have maneuvered the price down to get a better cost average to go long. And this is how the opposite of the bull trap is, that we've got people moving price up. They really want to take profits, but they can maneuver the price up to sell to get a better cost average by pushing it up to sell, because they know the true move is going to be down. So the big boys manipulating price to the outer range of support or the outer range of resistance to trap people thinking that it's a bull market, or trap people thinking it's a bear market. It's a matter of timing. It might be just a fade where it goes down and comes back up. And here it might be a fade, it goes down, breaks back up and goes down again. So these are the tricks that the big boys, the large money, can maneuver price around support and resistance. So we have to consider them in the battles of supply and demand. While price is in a range, so the range here, the big boys can manipulate the markets to help with them better cost averaging before price gets going, either at higher levels or at a much lower level. They're preparing their portfolios and their size positions by maneuvering and playing their tricks with bull traps, bear traps, bull fades, bear fades. Okay, let's have a couple of live examples. Now here we have an interesting one. It's Ford. This is quarterly data. Let me draw that again. So Ford's been in a range for a while, and here we have our bear trap, or possible bear trap I should say. Right, busted down there, pretty boring, nothing's going on, some strength here. The reason why Ford had a rally here, because of after 2009, people had to get exposure to, or big funds had to get exposure to the car industry. So what could be possibly going on here to create a reversal of this bear trap and to be bullish? Well, quite frankly, I think as I understand it, the Fords, the F-range trucks are the biggest selling Ford has, and they compete with the European Mercedes truck and the Vauxhall truck and a few other VW trucks. So if Trump puts tariffs on European cars, it's going to benefit Ford's pricing plan. So if the European trucks can't sell as well into US, Ford does better. And if tariffs go on, or the threat of tariffs go on the European trucks, then Europe might have to allow Ford bigger market exposure in Europe. So I'll be watching the White House Trump tariff talk with Europeans, because he's moving into that soon, and so Ford could actually benefit from that. So here we've got a bit of an A, B, C, so that's the bullish fundamentals. So this bear trap, these people will know the likelihood of the change of the tariff things, the likelihood of breaking into Europe or what have you. So Ford could be a good winner up to $14, which is obviously a 30-40% move. And the other one, let's have a look at the other one. Oh, we're going to look at gold. So here we have our quarterly data. As you see, we've got a nice, lovely base. Come on, I'll just do it again. Here we had a bear trap, right? Now the question is, could this be a bull trap rather than a breakout? Coming up to upper resistance. Well, obviously the fundamentals you think behind gold would see gold go higher due to money printing, easy money. But there's a couple of negatives we should be aware of. One is that the Dodd-Frank Act of 10 years ago has passed, and they've tried 4 times to install position limits on CFTC commodities futures trading, and I think 4 times it's been denied. Position limits would limit the amount of money or amount of position contracts could go short or long. So at the moment, if there's a big bull market, there are no position limits, as I understand it, for people to go naked short, i.e. resistance pressure on price advancing. So not exactly a fundamental to go bearish, but it's definitely a handbrake along the way. It's a judder bar, I would say. The other possible bearish fundamentals is the US dollar gets very, very strong due to economic woes, or the virus outbreak, and there's an emerging market retrenchment, and all people have to start paying loans back, and the US dollar does get very strong. This is the argument that the milkshake theory argument, where the US dollar actually gets strength and it goes high up to 100, 110, what have you. Or quite frankly, gold has been pushed up here to go short. It could be a bull fade because this is the first time it's gone to 150. We could get a fade. It comes back down to 140. I mean, gold is very, very volatile. Look at this area here. Boom, boom. Right. A 30% correction is nothing in the gold market. And the big boys realise this is a true breakout, because we've had a base. They've gone up here. A lot of shorts expect this to go down, and they want to get out of their positions. If you manipulate a 30%, 20% drop down to 130, those boys who are short can clear their positions, reverse the positions, and get longs. Whenever you have a breakout, there's bull trap or a bull fade are to be expected. You're not clear until you're, for example here, look at this price action here. This was the danger zone for a bull trap. Didn't occur, and it skyrocketed up. Okay? So we are in the danger zone for a bull trap or a bull fade. So we have to watch the fundamentals. You think the fundamentals deserve a higher price, but there's no reason why we can't get a negative quarterly bar or a 30% drop, just to allow these people who are massively short gold and silver to clear their positions and reverse. So that could be engineered quite easily as it approaches 1500, 1550, 1600. I'm looking at the GLD, by the way, so I should say 150 rather than 1500, because the gold price is at kissing 1600 on the futures. We're looking at a GLD and it's pushing 150. So here's the riskiest time. Is it a breakout? Is it a bull trap, or is it a bull market fade at resistance to allow positions to readjust? Quite frankly, you have to, because it's such a small market, you have to give some bias towards some sort of fade action at the minimum, just to allow people to clear their shorts and reverse their positions, or it may get really exciting and blow up, and therefore they have to reverse their shorts and buy it on the way up. So once again, that's the game you play, but it's nothing unusual for the markets to have an adjustment period around this early breakout phase of the gold market, or any market, quite frankly. Base, breakout, test, further advance. That's the talk of bull traps and bear traps, bull fades and bear fades. Thanks for watching.